Hello, my dear students. First year English section. This is Fatma Mahmoud Amara, and this is our fourth section on our course Partnership Accounting. And it's a great honor to be with Dr. Abdelhamid Shaheen, our course professor, the head of the Accounting and Auditing Department in our Faculty of Commerce, Sadat City University. In this section, we will complete what we talked about before in the previous sections. We talked about how to form a partnership, and we talked about how to divide net income or net loss between partners. Now we need to combine the financial statements of the partnership, as this exercise shows here, and this is a solved exercise in your book, page 30. Problem: the post-closing trial balance of two proprietorships on Jan 1, 2019 are presented below. In this table, this is the trial balance of the solo proprietorship of each partner of Salah Company and Meher Company. Each partner lonely. Salah trial balance here in the first two columns, and Meher in the third and fourth columns. This trial balance, as we talked in the solo proprietorship, first we prepare journal entries, and after that we post to ledger. After that we make closing entry. After that we make financial statement. After that we make a trial balance before adjustment. If there is any adjustment, we make a trial balance after adjustment. After preparing the trial balance after adjustments, we make the financial statements, balance sheet, income statement, retained earning, owner's equity, and any statement that we need in our organization. So this is a trial balance after adjustment for two solo proprietorship, Salah Company and Meher Company. Here is the item of the balance sheet: cash, accounts receivable, allowance for doubtful accounts, inventory, equipment, accumulated depreciation for equipment, notes payable and accounts payable, and Salah capital and Meher capital, and the last row is the total of each side, the credit side and the debit side. So this is an introduction in our example. Salah and Meher decide to form a partnership. This partnership will be called Sama Company. Sama Company, the new partnership that will result from merging Salah and Meher solo proprietorship, with the following agreed upon valuation for non-cash assets. They made a new valuation for the non-cash assets, and it will be account receivable for Salah will be changed, will be 35 for Salah. No change in the account receivable. It was 35,000 in the account, but in the trial balance, and the valuation after valuation it also $35,000. Allowance for doubtful $9,000. There is a new value for the allowance for doubtful accounts. There is a change here. It was $6,000 in the trial balance, but the new valuation states that the allowance for doubtful for Salah will not be 6,000 and it will be $9,000. Okay, inventory in the trial balance it was $53,000, and after valuation the inventory amount will change to $56,000, and the equipment in the trial balance have a value, it was $90,000, but after valuation the equipment will be $50,000. Also for Maher company there are some valuation, there is some item changed from the trial balance to a new items after valuation. Okay, all cash will be transferred to the partnership, all cash will be transferred to the partnership. So Salah cash will be transferred to the partnership and Maher cash will be transferred to the partnership, and the partnership will assume all liabilities of two proprietorship. كمان البارتنرشيب will assume all liabilities of the two proprietorship. Okay, further it's agreed that Salah will invest additional $10,000 livre Egyptian in cash, and Maher will invest an additional 38,000 livre Egyptian in cash. So the cash will be increased, the cash amount will be increased after transfer to the partnership. Each partner will transfer his sole proprietorship cash, and after transferring this cash Salah will make additional investment by cash by 10,000 livre Egyptian, and Maher will invest additional cash by 38,000 livre Egyptian. After this, what's required? So the required here, prepare a separate journal entry to record the transfer of each proprietorship assets, the transfer of assets and liabilities to the partnership. This is number A, like forming a partnership. Number B, journalize the additional cash investment. The additional cash investment that we mentioned here in the last line, journalize this additional cash investment. Number C, prepare a classified balance sheet. After preparing journal entries and forming partnership, we must prepare a classified balance sheet for the partnership, for the new company that will result from merging both sole proprietorship. Number one, let's solve about our solution. Prepare separate journal entry to record the transfer of each proprietorship assets and liabilities. A transfer of assets and liabilities of each sole proprietorship into the partnership. Number one, let's take Salah. Salah cash will be transferred to the partnership, so Salah cash will be transferred, so the cash will increase in the debit side by $28,000, and this number from where? From the trial balance that we mentioned in the introduction of the example. After that, account receivable. Account receivable after valuation, we will use the number after valuation. So let's look to the account receivable. Before valuation it was $35,000, and after valuation it was also $35,000. So we will deal with the $35,000 after valuation. So the account receivable will increase in the debit side because it's assets, and asset nature is debit, and as we said before, all assets item have a debit nature. So when it increase in its natural place. So the natural place is the debit side, and when it decrease, it will be decreased in the opposite side. So when assets decrease, it will decrease in the credit side, not in the debit side. Okay. After that, we have also an inventory before valuation it was $53,000, and after valuation it was 56,000 dollars. And we, as we said before, we will take the number of after valuation here from the second small table. This table, this is the number that I will shed it by the colors here. This is the number that we will deal with it, not the number in the trial balance, because there is a valuation for the number, this number. So the inventory, we will not take $53,000. We will take the $56,000 after valuation. Okay. And equipment will be $50,000, not $90,000. So, and Salah has allowance, as we said before, allowance decrease the account receivable, so it will be in the credit side, allowance by $9,000. And also we will transfer liabilities. So here in the trial balance, we have notes payable and accounts payable. These are the liabilities for Salah. Salah has notes payable by $36,000 and have accounts payable by $44,000. So these liabilities will be transferred to the partnership. And as we said before, all liabilities items have credit nature. So when it increase in its original nature, or in its original place, the credit side. When it decrease in the opposite side, not in the original place. So it will decrease in the debit. All this we will make summation for the asset side in the DR, and we will make summation for the credit side by the liabilities and the allowance, and the difference between them will be Salah capital. So Salah capital will be $80,000. Okay, and $80,000. After that, we have to prepare the same ledger, the same journal to Maher. Maher will transfer assets and will transfer also liabilities to the partnership. So what are the assets of Maher? Maher will transfer cash by $24,000 from the trial balance, and will transfer account receivable by $52,000 after valuation, and will transfer inventory by $40,000, and will transfer equipment by $30,000. And these amounts are the amounts after for the assets after valuation from the small table here, that I will color it by the yellow color in order to differentiate it and make it more clear in order to understand more. Okay, so these assets will be transferred to the partnership. So these assets will increase the assets in the partnership, so it will increase in the debit side. Also Maher have allowance for doubtful by $8,000 after valuation, and also have liabilities, notes payable by $30,000, and have accounts payable by $62,000, and these items will increase in the credit side, not in the debit side. Okay. So here we make a journal for Salah capital in order to transfer assets and liabilities to the partnership, and we calculate the capital for Salah by $80,000. and we transferred and make another journal entry for Maher or to Maher in order to compute the amount of capital for Maher in the partnership. Okay. Number B, journalize the additional cash investment by each partner. There is an additional cash investment, and we mentioned it in the last line in our example. We said that it's agreed that Salah will invest an additional $10,000, 10,000 livre Egyptian in cash, and Maher will invest additional 38,000 livre Egyptian in cash. So cash will increase by $10,000 in the debit side to Salah capital. This is a Salah investment, and Maher will invest $38,000 livre Egyptian cash. So from cash to in the debit side to Maher capital by $38,000. This is the amount of investment to Maher. Okay, so here cash will increase in to Salah by $10,000, and the Salah capital will also increase by $10,000, and Maher also his cash will increase by $38,000, and his capital also will increase by the amount $38,000. Okay. But after that, prepare a classified balance sheet for the partnership after transferring the assets and the additional investments. Okay, here we will combine both partner assets and both partner liabilities, and each partner capital will be mentioned in the owner's equity separately. Okay, so the assets, let's take cash for Salah from the trial balance. It was $28,000. Okay, and Maher will transfer cash from the trial balance by $24,000, and Salah will make additional cash investment, like as we said in the last point, number B, will make additional cash investment by $10,000, and Maher will make an additional investment by cash by $38,000. So the total amount of cash after transferring cash and after transferring the additional investment will be $100,000. So the amount of cash for both partner will be $100,000. Okay, the number two, assets. Number two, accounts receivable. Accounts receivable for Salah after valuation was $35,000, and for Maher was $52,000. So the amounts of account receivable will be $35,000 plus $52,000. It will be $87,000. Okay, accounts receivable minus or less allowance for doubtful accounts. The allowance for Salah was $9,000, and for Maher was $8,000. 9 plus 8, it will be $17,000. So the total amount of account receivable for both partner minus the total allowance for doubtful accounts for both partner, it will be net account receivable by $70,000. Okay, also we have an inventory. The inventory for Salah, it was after valuation $56,000, and for Maher it was $40,000. So 56 plus 40, it will be $96,000. So the total current assets will be the summation of total cash for both partners, total net account receivable for both partner, total inventory for both partner. So the total current asset will be $266,000 for both partner. This is the total current asset. Let's move to the fixed asset or the property, plant, equipment assets. We have here in our example equipment for Salah, it was after valuation $50,000, and for Maher after valuation was $30,000. 50,000 plus 30,000, it will be $80,000. for both partner. $80,000 equipment. So the total plant equipment or fixed assets will be $80,000. Let's make a summation for total current asset plus total fixed asset. It will give us the total assets, the debit side in our equation. It will be 346,000 livre Egyptian. Okay, and this is the assets side. Let's move to the other side of the balance sheet, which contains the total liabilities and partner equity. Partner equity, as we said before, not owner's equity. Partners equity, not owner's equity, because here we in a partnership, not in solo proprietorship. Our first item is the liabilities, current liabilities. We have note payable and accounts payable. Notes payable for Salah, it was $36,000, and for Meher was $30,000. We will add 36 plus 30, it will be $66,000. This is the amount of note payable for both partners. And the accounts payable for both partner for Salah was $44,000, and for Meher was $62,000. 44 plus 62, it will be $106,000. So the amount, or the total amount of current liabilities will be $172,000. This is the total amount of liabilities, or total amount of total current liabilities. And the other item is the partner equity. Partners equity, Salah and Meher. And we said that Salah will transfer a cash, as we make in the required number A, will transfer a capital by $80,000. The first journal that we made will transfer $80,000. $80,000 Salah capital. Also, he will invest $10,000 cash, which will increase his capital by 10. So 80 plus 10, it will be $90,000. So Salah capital will be 80 plus 10, will be $90,000. And Meher also will he will transfer assets and liabilities, so the amount of his capital will be $46,000. And he will also invest make additional investment by cash by $38,000, which will increase his capital also. So the capital will be $46,000 plus 38,000, it will be 84,000. So Meher capital will be $84,000. So the total partner equity will be the amount, or the summation of Salah capital by $90,000 and Meher capital by $84,000. So the total amount of the partner equity will be $174,000. And this is the other item in the credit side. So the summation for the credit side will be total amount of liabilities plus total amount of partner equity. Total amount of liabilities is $172,000, and total amount of partner equity is $174,000. So the total liabilities plus partner equity will be $346,000, and this side must equal the asset side, as we said before, and we repeat again. Please, my dear students, please revise, make a quick revision for the accounting equations that we take in the first term, and the items in the balance sheet and the items in the income statement, and how to prepare a balance sheet. This These matters are very important in order to complete our course. So please revise accounting equation again, please as financial statements again, and if you have any problem, just let me know.